How the heck do you buy a home in South Carolina? Well, buying a home is one of the most important financial decisions somebody can take. It's a great first step to setting you and your family up for long-term financial stability and success. But the process can seem overwhelming and you just don't know where to begin. I get that. And in this video, I'm going to break down the South Carolina home buying process into small chunks so you feel confident in your future purchase. Hey, what's up y'all? It's Shawn, your Charleston Realtor. As many of you know, I have purchased my fair share of homes and helped many dozens of clients purchase their homes in South Carolina. In this video, I'm going to walk you through the home buying process here in the Palmetto State so that you're armed with the proper terminology, expectations, and tactics when it comes to purchasing your first home. First, it would mean the world to me if you could give this video a thumbs up and hit the subscribe button. As a new content creator, this helps me out a ton. Alright, so the first step to the home buying process is finding a real estate agent, sometimes called a realtor. If you're wondering, a realtor is just a member of the National Association of Realtors, which is a real estate union. Not all agents are created equal though. Some work with tons of buyers, some only sellers. Some agents do a couple transactions a year, others do dozens. Many agents aren't even full-time. It's more of a side hustle for them. Some agents are very experienced with first-time home buyers, or VA buyers, or investors. Others not so much. Some are skilled negotiators who will fight on your behalf, and others will capitulate at the first sign of resistance. Finding the right agent for your situation is important. Ask a realtor what value they can provide to you. Ask how responsive they are, and if they'll answer their phone at 8 p.m. when you have a question. At the end of the day, the realtor services are free for you as the buyer. You should never have to pay for your realtor since they receive compensation from the seller during the transaction. There are times when this might not be the case, but 99 out of 100 it is. So let's say you found a realtor. The next step is to get pre-approved with a lender. The way I explain it is your pre-approval is simply a ticket to get to the show. The lender will run your credit and do a cursory income and debt verification to determine the maximum amount you'll be permitted to borrow. This should help you and your realtor refine your home search based on what the loan amount you'll actually qualify for. The pre-approval with one particular lender does not lock you into using that lender for the loan, but more on that later. The pre-approval letter is usually good for a couple months, so it's better to knock it out sooner than later. Let me pose this question. Let's flip the script and ask if you were selling your home and somebody wanted to view it, then you'd have to clean it up, pack up your pets and your kids, and leave the home for a couple of hours so a prospective buyer could view it. How would you feel if that buyer wasn't qualified to buy the home to begin with? It would be a major waste of time for you. So the pre-approval process just helps you and your realtor rein in those price expectations. You can't go buy $1 million home if you only have the income to afford a $400,000 home, for instance. Also, if you want to make an offer on a home, the pre-approval is almost always necessary. What if you view the perfect home on a Saturday, but you can't put in an offer because you don't have a pre-approval? The point is, you need a pre-approval sooner than later. Knock it out, the quicker the better. It usually takes 20 minutes of your time and just as long of time for the lender. And then you don't have to worry about it. Alright, so you have a realtor and a pre-approval letter. You are completely armed to go buy a home. Next, just coordinate with your realtor to view homes and find one that fits you and your family's needs. Now it's time to write an offer. What goes into a contract? Well, there are a lot of things, and it's your realtor's job to walk you through each paragraph of the contract and explain what each one means. Every buyer and seller has a different situation, so no two contracts are equal, but they usually progress down the same path. So I'm just going to say congratulations, you and your realtor negotiated and now you have a house under contract. We are now in what we consider the escrow period, and a whole bunch of stuff starts to kick off at once to get you to closing, which is normally 30 days away. Let's keep track of our path to closing with this timeline here on the screen. Your realtor should have discussed this idea called earnest money, or your earnest money deposit. This is effectively your security deposit. It's your skin in the game. When you close on the house, the earnest money comes back to you as credit at closing. It is your money, and it remains your money unless you unilaterally decide that you don't want to purchase the home anymore. In that case, the seller usually keeps it. The earnest money is typically paid to the closing attorney unless your agent's brokerage holds the earnest money in a trust account. You usually have a few days after your offer gets accepted to either wire or hand a check over to the closing attorney. Let's call it 2 days post-contract gratification. Your earnest money will be due. Also, within a few days of getting under contract, you need to pick a lender. You do not necessarily need to go with the same lender you got pre-approval with. Some people like to shop around lenders to see who has the best rates and fees. Not all lenders are created equal, so choosing the right one may save you money. I want to caveat this with The only way to compare lenders is to do an apples-to-apples comparison with their rates and fees. They are legally required to give you this document called a loan estimate, or LE for short. You must have a loan estimate from multiple lenders in order to compare them. Lenders make money two ways in a real estate transaction. First, from the fees that they charge you, and second, from the spread on the interest rate. Both of these can be negotiated. Again, just keep pestering lenders for a loan estimate until they give it to you. You usually have to choose a lender pretty quickly after going into contract. So let's call that 5 days. In South Carolina, we have an inspection or options period that we call due diligence. The shorter the inspection period, the more competitive your offer is. Normally, I recommend 7 business days for my buyers, but it's totally up to you. This is your opportunity to go into the home, hire inspectors, and try to figure out everything wrong with the home. Afterwards, we can deliver a repair request to the seller. The seller can then agree to perform all repairs, agree to some repairs, agree to credit the buyer more closing costs, or flat out refuse to do repairs. At any point, you, the buyer, can terminate the contract during this period. There is a separate fee tied to canceling during this period called the termination fee. The termination fee is different from your earnest money, and you will only pay it if you terminate the contract during due diligence. The actual dollar value of this fee is part of the original contract and is negotiated between you and the seller before even going under contract. Typically in South Carolina, it's around a few $100s, maybe up to $1,000 or so depending on the price point of the home. There are a few other states where the termination fee has gotten completely out of hand, like in North Carolina, but we're still a little sane here in South Carolina. The due diligence period is typically your last leverage as a buyer to negotiate a more favorable terms for you. Let's say the due diligence period will end 10 days after being in contract, and you and the seller have come to an agreement on the repairs that will be done to the house or any credit to be given. Now next, at some point, we will need to hire a termite inspection. In South Carolina, we call this a CL100, which is just the name of the form used. Essentially, this is an inspector who comes in and looks for signs of termite or other wood-destroying organism infestations, or any damage caused by them. This is one of the 3 standard contingencies in the contract, and as long as you don't waive your contingency, the seller is obligated to deliver a clear CL100. This is an inspection that is performed by a licensed termite inspector and can be done anytime within 30 days of closing. Typically though, it's performed after the due diligence period. Let's just assume that it's done at the 15-day point, so halfway through your escrow period. Something else happening behind the scenes is the title search. This is handled by the real estate attorney who either performs the title search themselves or hires a third party to do it for them. You will pay for this search at closing and it's lumped into your closing costs. Essentially, we want to make sure that there are no other claims on the title of the home besides the seller who is selling the home. Typically, it's a non-issue, but I've seen messy title issues before. Usually, the attorney doesn't order the title search until after due diligence is over, and it typically takes about a week. So let's say that the title search will be completed at day 18, though again, this is pretty transparent to you. Another protection you have is the appraisal. This is typically transparent to you as a buyer, but it occurs behind the scenes and you find out about it after the fact. Essentially, the appraisal is something that is paid for by you and it's ordered by the lender in order to ensure that you're not overpaying for the home. A licensed appraiser will go out and look at the home and formulate a value of the home based on comparable sales approach. In essence, he's looking at what other homes in the neighborhood or surrounding areas sold for. The bank wants to be protected since they are essentially giving you a loan and using your home as a collateral. They want to ensure that the collateral is worth what you and the seller think it is. The inner workings of an appraisal and issues that arise from it are left for a separate video, but just know that this can happen at any point in the contract. Let's call it the 20-day point for continuity's sake. Lastly, let's touch on the other major protection that you have in the contract. That is the financing contingency. You're probably getting a loan, either a conventional loan or one that is government-backed, such as a VA, USDA, or FHA loan. All of these loans are considered conforming loans, and as such will be sold on the secondary market after you close. So what does that mean? Well, you're getting a loan and paying interest to the bank. In the grand scheme of things, the $1,000 a month in interest is not going to make that much money for the bank. So what they do is they bundle up your mortgage and hundreds or thousands of other mortgages into something called a mortgage-backed security, or MBS, that they then sell to other banks and financial institutions. If you've ever seen the 2015 movie, The Big Short, it does a really good job of depicting how the quality of the underlying mortgages in these MBSs brought down the entire financial system in 2008. Well, how is this relevant to you? Well, in order to get a loan, the process is going to be long and tedious. The lender will need a ton of paperwork from you, usually a couple years of tax returns, W-2s, bank statements, pay stubs, and a whole slew of other things. Having enough cash for your down payment and income from your job isn't necessarily enough sometimes to get a mortgage. The lender will submit your file to underwriting, which is like the pre-approval process except on steroids, and every aspect of your financial past will be poured over. This is the longest part of the escrow period. Don't fret, this is completely normal and expected. The timeline here can get pretty fuzzy, but the major milestones are the conditional approval, the closing disclosure getting sent to you, and then the clear to close. You should come out of underwriting with conditional approval and no later than 3 business days before closing receive something called a closing disclosure, or CD for short. Let's call it 27 days after going under contract. Then at the 28 or 29 day mark, the lender should give us the clear to close, meaning that all conditions have been satisfied and you qualified for the loan. Typically, the attorney will coordinate with the lender and tell you exactly how much money you need to close on your home. Don't be like me when I first bought my home. I showed up to the attorney's office with a debit card thinking I could just charge my down payment. Turns out, I needed to wire money a day before. Now this is something I verify with my clients beforehand. So on day 30, we'll go for our final walkthrough and make sure the house is still there and it's in the same condition as when we went under contract. And then we're good to close. We head to the attorney's office and you get to sign half a ream of paper. And just like that, you purchased a home. It wasn't too complicated, was it? Now obviously there are a lot of nuances here that I didn't cover. I can't replace your personal relationship with your realtor in a 10-minute YouTube video, but these are the main bullet points that your realtor can expound upon. And also keep in mind, every escrow period has their hiccups and doesn't go exactly as planned. So thanks so much for watching. Of course, if you'd like to chat more about finding the right realtor anywhere in the country, I have a network. Or if you want to talk about Charleston real estate, I'd love to talk. My contact info is in the description below, and I'll see you in the next video.